Welcome back, ladies and gentlemen. Thank you all for joining me today. I'm really excited to just kind of bring you a quick video. Peter Lynch, who's one of my favorite value investors, of all time, actually went on CNBC recently and did an interview with them. Now, this is just going to be me going over a clip of it and kind of talking through the mindset and things like that. And I feel like, sometimes people like wonder, especially when you're learning, you haven't read Peter Lynch before, like where is this all coming from? So I'm hoping that I can kind of diagnose that and give you guys some more info today, and maybe just give you a little bit more insight into mindset and kind of what I'm doing as well. So if that's something you're interested in, make sure to subscribe to the channel. We do this kind of stuff all the time here on the channel. But with that being said, let's dive right into today's video. Come on over to the computer. I'm just gonna share screen so you can watch it while I do. And if you have any questions though outside of what I've kind of addressed, let me know down in the comments below.
We are now joined by a very special guest. Can we call him a legend? I think we're going to. Legendary investor Peter Lynch. He is with us from Boston this morning to share his perspective on the economy, markets, and the work he's doing for the Catholic Schools Foundation. Peter, of course, is the vice chairman of Fidelity Management and Research and advisory board member of Fidelity Funds.
That is such a crazy
1977 to 1990.
And the Magellan Fund's still running. That is such a crazy
record. Growing it
record.
from, you ready for this, $20 million to $14 billion in 1990 at the time of his retirement. Buy what you know is what Peter taught us, and it's so nice to see you this morning, Peter.
Good to be here.
So let's talk about buy what you know. I'm so curious these days how you're thinking about the economy.
Well, I think people, they're investing in individual stocks. It's sad they're careful when they buy a refrigerator or an airplane flight. They're careful with their money, and they'll hear about a stock on the bus, and they'll put $5,000 or $10,000 on it. They have no idea what they do. So you're really got to be careful. Look at the company, look at the balance sheet. What is the reason the stock should be higher? The sucker's going up is not a good reason.
Is your sense, though, that the style of investing that you pioneered is still doable and winnable today?
Well, I think looking for something different, looking for something that's a good story. I mean, who would have guessed TJX, a local company, would have gone up 50-fold, or Stop and Shop would go up 10-fold, or Analog Devices, or NVIDIA. I couldn't pronounce NVIDIA. So you have to find a company that's either a turnaround or a company that's going to grow, like Panera or, Family Dollar stores. I'm not saying that buys now, but that's what's made our, Sears is rolled over. So Kmart's rolled over, IBM slowed down. But we've had new companies come along. I mean, that's the nature. You have to be looking for new companies and look at the balance sheet. If you can add 5 and 5 and get reasonably close to 10, you should be able to look at a balance sheet and say, here's two depressed companies. They've gone from 50 to 3. One company's got $3 million in cash and no debt. One's got $3 million in debt, no cash. Which one are you going to buy? I mean, that's not too hard to do.
Yeah, it's crazy to me. So kind of going back to his first point, one of the things that I think we've seen over the last, maybe I've personally seen it a lot, is the fact that you actually have, people will hear about a stock. They'll hear about it on Reddit. They'll hear about it on the bus. They'll hear about it from their friends, their family. They'll just hear about a stock. They'll hear a ticker, and they'll, someone will obviously like talk it up. They'll say, it went up 10% yesterday. It's going to keep going up because that's what I think. That's what I believe. That's what they're hoping for. That's really what that's writing on, is hope and speculation. But you hear about it and you see like people, especially in 21, you see a lot of people hear about a company, they jump right into it, and then they lose all their money, or they lose a lot of their money, and then they think like, buy the dip, only buy the dip. That's all we know. And so you buy the dip and it goes down, and you buy the dip and it goes down, and then it buys the dip and it keeps going down. And it becomes frustrating for people because they don't know what to do, because they followed all the rules. They followed the buy the dip. They followed the don't be afraid. They followed the, hold while you're down kind of thing. And in reality, a lot of it comes from the fact that they don't know what they own. They don't know what they own. And a lot of it, when you have that happen and you don't know what you own, there's a lot of risk in it. There's a lot of risk to begin with when you're investing when you don't know what you own, let alone when the company itself being risky, like, some of the meme stocks that we've seen come out and things like that. So when it comes to that, he says, buy what you know. That's that concept really comes from One Up on Wall Street, and it comes from a couple of others' books as well. But buy what you know is really saying, rather than trying to invest in this crazy software company, let's say you work in the mining industry and you just found stocks for the first time, rather than investing in software that you have no idea what it does, you have no idea how sticky it is, you have no idea what the business model is, and you're just investing because you hear a name, you hear a ticker symbol, and you're like, that sounds good to me, or it's gone up 10% this week, it's got to keep going up. Rather than investing in that way, buy what you know. So if your circle of competence leaves you at just retail stores, there's good retail stores and there's bad retail stores. Look at the balance sheet, look at the financial statements, look at the 10K, 10Q to figure out what opportunities are there. And that's kind of what he's getting at. And that's a lot of what he did. Was he was driving around to go look at Best Western when it first came out and first was growing. Okay, Best Western, it's a hotel chain. People have stayed there before. You kind of know what it is. You can go stay there. You can go do it. That's kind of the idea behind buy what you know and own what you know. And the thing is, too, is that the other last point that he kind of makes is you need to make sure that when you're investing in companies, you're keeping a watchful eye over the trends and kind of the things that change throughout the year. Because, again, you have a company like Sears. Sears dominated retail. It dominated everything in its space at that time. Amazon comes along. E-commerce comes along. Cheaper big box stores come along. All of a sudden, Sears is going under and out of business. So that is part of it too. You have that market cycle where businesses that, were fundamentally sound at one point may not be fundamentally sound anymore. So you can't just assume that every company that you own is going to stay forever. And that's part of it too, is you need to make sure that you're paying attention, you're watching the trends, you're keeping up with the competitors, you're making sure that, you have these eggs in your basket. You have this little basket right here, and you're watching over it. You can't just look off to the side or go looking for other eggs and leave your eggs unattended. It's kind of the best way to think about it. But I really think that Peter Lynch really hits on the point every single time he talks. You can go through all his old interviews from years, decades ago, and he hits on the exact same points.
Peter, I watched you closely because I was in the business back then, and I don't know. Do you remember how many S&Ls went from mutuals to stock trade that you made just buku bucks on back then? I mean, I don't know if you missed any of those, and they were all big winners. They're all big winners. They were all big winners back then. What do you think of the financial sector right now and what happened? We saw with First Republic, and I'd just like to get your insight there since you were so good at that sector.
We had a terrible financial crisis in 99-1. I think almost every major bank in Texas went under. Bank of New England, one of the oldest banks in the country, went under. It's in 08-09, the banks were doing these no-doc loans and second mortgages and home improvement loans, and people were buying boats with it. Now the banks are being much more careful. So we've gone through other crises. Some banks will go under. 400 went under after 08-09. Now we have stress tests. I think the banking system has improved. There'll be some companies go under. That's the nature of it. It's nothing like, imagine 1980-81, we had double-digit inflation, double-digit unemployment, and people worried the Japanese were going to take over the world. I mean, we were hopeless. I mean, there's always something to worry about. I'd really, in my over 50 years of doing this, I think I'd be worried if there was, somebody didn't bring up something to worry about. That's the nature of the business.
I was joking because I'm a Reagan guy, and I was there. I started at Merrill in 1981, so I remember what happened. I remember my feelings in 1981, and I remember my feelings, how I felt by 1985. Ugly. And you had a tailwind. I had a tailwind because of what we did. We're not going to do that again. We're not going to cut taxes. We're not going to stimulate the private sector. We're kind of headed the other way. Did you have a tailwind? Will we ever have a tailwind again with this generation?
Well, we've had 13 recessions since World War II, and we've had 13 recoveries. Maybe we're going to have one. If this is a recession, it's probably the most predicted one ever. I never know when we're going to go. I'd love to know the future. I think it would help. I'd be a better investor. I'd pay $5 extra for next year's Wall Street Journal. It would really help. Right. I cannot predict the future, but this recession is so expected, so predicted. Maybe it's coming. I don't know.
So it's crazy to me, and that's kind of just the end of that clip. But there is like an 11-minute if you go on the CNBC Pro piece. But really, the final thing that I kind of want to mention for you as kind of the listener is you heard him say, there's always something to worry about. There really is always something to worry about. And, whether it's macro, whether it's micro in your industry, whether it's, the specific company doing this or ChatGPT or AI or like insert buzzword from the last 5 years here kind of thing, there's always something to worry about. Now, it's not that you don't care about the macro. It's not that you don't care about these, trends and dynamics happening. It's more so the fact that you're never, ever, ever going to get something that's just a complete layup and that doesn't have like some form of risk. So you have to take into consideration there's risk in this, business model. There's risk in this fundamentals of this company. What is that risk? What could happen? But you have to, be aware of what could happen. And part of the things that will happen is you'll have, up cycles, down cycles. You'll have, up and downs in different markets. You'll have real estate going up and down. You'll have rates changing. All of these things impact, just the general market, not just stocks, not just, equities in general. It'll impact the general market. So you're looking at something like the Fed fund rate. It's going to hit, 5% today because I'm recording this on the May 3rd, 2023. If you look at it, it's probably going to hit 5%, which it hasn't hit 5% in like a decade and a half almost. So when you see this happen, you have to ask yourself, how exposed is my company? If you look at like the Fed fund rate, we could go into that example. If my company is taking out variable interest rate debt and the rate keeps going up, their interest expense is going to keep going up now. If they have fixed rates at a really low rate, and the Fed rate goes up and they're not issuing a bunch more debt and they're just going to continue running their company, they may see a slowdown, but you're not going to come crumbling down necessarily. Now, that's not to say that the equity price won't come down. So that's part of it too, where you don't know what's going to happen in the future. And that's why if you invest with the margin of safety, like we talk about with Ben Graham and Warren Buffett, if you invest with the margin of safety in your investments, there's a little bit of wiggle room that you can play with now rather than being stuck with, I invested at what I thought was exactly fair value. The market went down because rates went up. All of a sudden, the unknown became known kind of thing. So that's part of it, and that's part of investing, but you have to just kind of, feel your way through it and kind of learn and read about the history so that way you're not doomed to make the same mistakes that others have made in the past. And that's kind of what I've been doing, is just reading and trying to read up on different trends, trying to read up on different industries, trying to read up on the value investors, super investors, and people, who are do and don't disagree with. And that's kind of what I've been doing recently. I've actually been reading Howard Marks' Master the Market Cycles book, as well as Chip Wars from Chris Miller. So I'm learning about industries. I'm learning about other people's knowledge and kind of gaining that. And I think that you should do that too. So that's why I'm hoping that this video, I hope you find it helpful and that you actually are going to be able to take something out of this. And I think that if you haven't already, like if you're just new to investing, you're just finding me, you're just finding investing in general, you're just looking into stock market investing on YouTube, I think you should go on YouTube, look up Warren Buffett's old interviews, look up Peter Lynch's old interviews. I think Peter Lynch is probably a little bit more approachable from a new person perspective. So look up One Up on Wall Street, look up Learn to Earn by Peter Lynch. He does a great job explaining a lot of the concepts that everyone else kind of talks about, but he does it, I feel like, in a simpler manner. And it's a very, easy to understand because, again, the way that he invested was buy what you own. He didn't care about the next AI stock. He didn't care about the teraflops on a, old CPU or anything like that, is what he has said before. So make sure you buy what you own, learn about the markets, learn about what other people have done, mistakes in the past, either mistakes or wins really in the past, and what people are looking for as far as like Warren Buffett, maybe Charlie Munger and people like that, and that, general group of people, what they are looking for when they're looking for companies. And honestly, again, I think a lot of it's learning. So you got to continue to learn, even if you have had a winner, if you've had something go up a ton of percent, you still got to continue learning and continue to build on that knowledge. So with that being said, though, thank you all for joining me today. I hope this was really informative. Let me know what you think about this style of video, and also as far as the audio goes, let me keep letting me know about the audio experience as well. So with that being said, thank you all for joining me today, and have a great day and happy investing.